Owners should be thinking about, should I grow or am I ready to sell? And depending on that, what are the characteristics in a company that I seek that would make my company better? And then who are the advisors who can help me implement this plan?
The Industrial Growth Institute podcast connects you with the big thinkers, makers, and subject matter experts across all aspects of an integrated B2B industrial revenue growth function. From strategy, board oversight, and transactions through all the phases of manufacturing marketing, the complexities of industrial sales, and the nuances of marketing and sales technology and customer experience, I speak with guests who bring insights, innovative perspectives, best practices, and twists on traditional approaches. Each episode explores high-level thinking and in-the-weeds actionable tactics. If you enjoyed these discussions, then please help me out by liking and sharing the podcast, and especially by leaving a comment and giving a review. So with no further ado, let's jump into this episode. Welcome to the Industrial Growth Institute podcast. I'm Ed Marsh, your host, and today I'm joined by Rudy Scarito, who's been an investment banker for over 30 years, working for both global full-service firms as well as smaller regional firms. Now, why an investment banker, you might ask? I mean, we talk about marketing and sales and other topics, but this show is fundamentally about growth of a business. And too often, I think we assume that means organic growth. But I believe that strategy should consider two kinds of transactions routinely. One is acquisitions or growth, and the other is an exit. I mean, the reality is that every company, even lifestyle companies, have a price. And whether it's family owned or not, there is a time when selling part or all of a company makes sense. And Rudy's going to take us on I think, a fascinating journey through how the owners, board, and executives might think about those transactions and what's involved in them. So first, who is Rudy? Well, she's got a powerful CV that I think as she speaks, you're gonna understand the depth of it. St. Paul's School, cum laude from Dartmouth, Harvard Business School. She's held a number of roles at Lehman Brothers and Goldman Sachs and has extensive insight into M&A transactions, debt and equity capital sources, and also various private placements. In 2009, she founded her own firm, RS Finance and Consulting, LLC, where she advises corporate clients on mergers and acquisitions, capital raising, and other financial advisory assignments, particularly working with companies in the $15 to $50 million range, including a number of industrials. She's the president and member of the board of directors of ACG, the Association for Corporate Growth Boston chapter, and has served on numerous public and private corporate boards and nonprofit boards, including she's a leader in the Exit Planning Exchange in Boston. She served as an expert witness on various business, valuation, M&A, capital markets matters, and she holds a whole list of FINRA licenses. So in other words, she's bringing the goods today for middle market manufacturers and industrial companies who may not think about transactions enough as part of their strategy planning. I know there's going to be some serious nuggets in this conversation. Please make sure that you like it, comment, share it, subscribe, so that others are going to benefit from Rudy's incredible experience. So with that introduction, thank you so much for joining me today, Rudy.
Thank you for having me. I'm happy to be here.
I'm excited about it. I've been thinking a lot about this conversation because it's a topic that I think isn't front of mind enough for a lot of industrial companies. Before we get into all of that, though, I'm thinking 2009, that was a tough time or a great time to start your business? What prompted it at that point?
Well, we were in this global economic crisis. I think they call it the GFC, the global financial crisis.
Right.
And there were huge chunks of investment bankers and other people in the financial services industry got wiped out. A number of us got laid off, especially the more senior you were and the more expensive you were. And there was a lot of cost cutting. And so I and almost 100% of my division at this firm I was working for got laid off. Wow. And all the partners were sitting around talking about what to do. And some of us decided to work together, start our own businesses, and some of us decided to do it on our own. But there really wasn't much to do at the time. The market was flat on its back. So we just sort of sat around. But over time, 6, 9, 12 months, we started to see some signs of life. And that's I didn't really get started until about 9 to 12 months later. That sort of spawned RS Finance.
Got it.
Yeah.
A number of people I've spoken to started their businesses then. I mean, there's I think common wisdom that tough times are a great time for entrepreneurs to start things. So it's interesting to hear these stories.
Yeah, there's nowhere to go but up, really, at a time like that. So you think this is about as low a risk time as ever. So why not?
Right. Part of the reason I think this conversation is so important is that there are some secular market changes happening now that, may not result in another 0809 greater global financial crisis. But I think we could be coming up on a good time to try to buy a business as the economy slows and this silver tsunami of exits quickens. What are you seeing in the market? What's your sense about where we may be and what's coming up?
Yeah, you mentioned earlier when you were introducing me that my focus is on companies valued somewhere between 15 million and 50 million. And that segment of the market, which I call the lower end of the middle market, is really active. And it's the silver tsunami that you talk about. The aging baby boomer population, people hitting 60 or 70 and saying, I want to do something different with the rest of my life. And so I haven't seen, the market's been crazy on my end, so busy, where owners will come to me and say, and it was a recent example, a guy said, I'm 62, I look like I'm 48, I'm in great shape, I want to travel with my wife, I want to ski, I want to play golf, I'm done. I've been running my company for over 30 years and I'm ready. And so he's one of a number of people who've said something similar to me. They just we're living longer now, and people want the second part of their life to be something other than work. So we're busy. We're seeing a lot of interest in selling.
And sometimes it's people thinking ahead. Sometimes people may just have this idea. I mean, I've often heard many boomers say, I'm going to die at my desk. They think they love working. They love the business. They don't want to think about the challenges of transition or transaction or legacy. They don't want to deal with it. So they just keep working. But then something happens and triggers some very kind of perhaps deep introspection. What do you see as the most common trigger that brings people to the point where they say, you know what, I need to get serious about this now?
It's usually a medical issue, at least in my experience. Either the person himself, typically my clients are men, but sometimes they're women, or it could be, a family member, a spouse, or a child. Or even a parent at that point. But there's some catalyst that makes you think, I only get one life, and is this what I want to do? Am I living my best life? Am I living my life to the fullest? And it's that kind of introspection, generated by a catalyst that makes people say, okay, I'm ready.
Makes sense. So we're going to spend time talking about how to prepare. But first, I want to back up. I believe very strongly that understanding someone's background gives a lot more depth to the insights that they share. So I read your bio, but give us a little bit of color commentary on your career that led up to the GFC and that transition that you went through starting your own firm.
Sure. Yeah. So I was coming out of Dartmouth College, and I wrote, like so many students, right? You say, this is great. I had a great 4 years, but I have a lot of student debt. And so I was motivated to find a job where I could start to, pay my expenses, but also repay the debt, the student debt. And firms came on campus to interview students for entry-level positions. So that made it easier, right? If they're coming to you, all you need to do is get an interview, and then hopefully you'll get a job. So some of the investment banks, I was somewhat familiar with that business model because my father had been an executive recruiter finding research analysts to work at these firms. Okay. So I didn't know investment banking per se, but I knew the firms and I knew the reputations. And they advertised that they wanted to hire the best and brightest. So I thought, I want to compete at that level. I want to be the best and brightest. So I'm going to apply for these jobs. So I was fortunate enough to get an offer from Lehman Brothers and other firms, but Lehman is the one that I chose. And I went there right after college, and I loved every minute of it. It was exactly as advertised. It was fast paced. There were really smart people who challenged you every day. You were interacting directly with the executives of companies, and you were doing work that made a difference to them and the business. So I liked that sort of high intensity, high impact kind of role. And over the years, I was in New York for 11 years. And then because of an illness in my family, my dad got sick. So I came back to Boston to be closer to where he was going through his illness. And that sort of took me into the middle market, smaller companies, less than $1 billion, typically privately held. And I had gotten good M&A and capital markets experience in New York. So the firm I joined in Boston wanted me to do capital markets, basically raising money, equity and debt for privately held companies, a lot like the ones we talked about, less than 100 million, let's say, in value. So we're raising capital to help them grow. They didn't want to sell, but they wanted to grow. And so I had the expertise to figure out, okay, how much capital? How should the capital be structured? What kind of capital? And so I did that for 10 to 12 years. And then we had the GFC. And so capital raising is very difficult because the provider of the money doesn't have control of the company. And so there are a lot of bells and whistles, constraints that the capital provider puts on the capital and on the business owner. And it makes it very hard to get those transactions done because you have business owner's interest over here on one end and the capital provider over here. So when I went off on my own, I thought, it's easier to do M&A. I'm not suggesting that M&A is easy. I'm just saying it's easier.
Right.
Because the seller knows that he or she wants to sell. And then the buyer knows that he or she wants to buy. And so there's an initial agreement on what's going to happen at the outset. And then it just becomes a question of getting the value and all the terms and conditions. But M&A's been exactly as advertised. It's not easy, but it's a lot easier to do than a capital transaction. And I do 1 or 2 a year. So I've been at this now quite a while. It's been everything that I dreamed it would be.
Oh, that's neat to hear. Were you, by any chance, I pick up on your intensely competitive nature. Were you a college athlete?
That's so funny. I have no idea how I come across. Yes, I was a college athlete at Dartmouth. So I played soccer. I played, you play as a kid, but then in high school, we were required to play the sport. So I played in high school and then I played in college and I was captain of the team. And that's part of the reason I got hired at Lehman Brothers. The person running that program, the entry-level analyst program at Lehman, was an All-America swimmer at Princeton. And so it was a woman, one of the first women in a senior position at a major investment bank in New York. And she ran this analyst program and she looked for collegiate athletes. She looked for people, she thought, I want intensely competitive, but I want team players, people who will do what it takes to get the job done and who will extend themselves for the greater good of the team. And the team includes the client, but also your colleagues at work.
Sure.
So it was a great environment because we were all pulling in the same direction. And she managed it quite well. She picked the right kind of talent, the right kind of character. It's
an interesting thread that I'm finding comes out of these conversations I have with people, that military veterans and NCAA athletes bring an intensity, a focus, obviously a team mentality, a grit, a willingness to do what it takes, a commitment to achieving as opposed to just checking the box that really pervades a lot of the very successful folks that I talk to. It's interesting.
Yeah, no, thank you for saying that. I agree with that.
So you talked about how M&A transactions are often tough to get done. We hear about all the horror stories of what a small percentage of them actually yield the value people anticipated. What do you see in that lower middle market in terms of company success in integrating?
In integrating after the deal?
Right.
Well, to be honest, I don't get to see a lot after the deal. So but I will answer your question in a second. Typically, moving the process, moving the company through the process of the deal and their various stages. And then I'm making sure that the deal gets done on terms and price that are best for my client, the seller. But it's incredible because we're spending 10, 12, 16 hours a day together, day and night, weekends. We're battling it out. And then the deal closes and that's it. You never see them again. You think, what happened? Like you were right there. But that's just because it's a reality of the situation. The buyer has its own view about what the future will look like. Now, in my end of the market, the seller is often required. The seller is so important. The business owner is so important to the people at the company and to the clients of the company, the customers, that the buyer typically recognizes this and asks the seller to stick around for a year or two. And that's when I get to see the integration. So really good buyers will think about this in advance of the closing and start to think about, okay, where is the talent within the company? Who does what? How do we match that talent with talent at the buying company? How do we use the company's people resource, the selling company's people resources to advance the mission of the buying company? And there's a lot of forethought about how the company will be integrated. But typically the buyer has somebody who connects with the operating, the day-to-day plant manager, for example, on the seller side. There's usually a human resources consultant who gets involved to sort of talk about culture in each company. And is there a match here? And where might there be a difference so that we can bridge any gaps? There's usually somebody there's always people on the finance side and talk about, okay, how do we match up from a financial standpoint? Where are the strengths and weaknesses? Right. So as M&A has gotten more and more mature as an industry, we're seeing like consultants kind of aggregate around buyers and so much to say we can help facilitate that transition. But I don't really get, I'm living with the company before it's sold, and afterwards I sort of get snippets.
Yeah, you must get some of it to the extent that earnouts are a frequent part of a transaction. So you're getting insight into, is the company performing well?
Well, earnouts is a very interesting topic. I do everything in my power not to have them. This is usually, you do see them, especially on the very low end of the transaction size. And usually you see them because the seller says, I need this much to retire. And the buyer says, your company's worth less than this much. And so, but if you help, the buyer will say to the seller, if your company performs at this level for the next couple of years, we'll give you some incremental purchase price. And so that's the earnout. I tell my clients, cash is king. You need every penny that you can get at closing. You should never count on getting anything afterwards. And it's not necessarily because anyone has any ill intent to subvert that. It's more, once you sell, it's not your company anymore. Now someone new comes in and says, you were doing it that way. We're going to do it this way now. You don't control the P&L. You don't control the people. You don't control the business. So the earnout becomes very difficult to achieve. And I just don't like the risk profile. I say to my sellers, this is what we can get at closing. You have to be happy with this. We'll try to do better. But if you're not happy with this, then you should probably not sell.
Makes sense. All right. So you're using some terms of art. Let's just make sure level set for folks that kind of are aware of M&A, like myself, may not be deeply familiar with the work that you do. You call yourself a sell-side investment banker. So number one, what exactly does an investment banker do? And then number two, what does sell side mean? And why is there even a distinction? Would you ever talk to a buyer? Help us understand that piece.
Yeah, that's a great question. I don't even appreciate these terms that have come so commonplace. So thank you for mentioning it. Investment bankers, I tried to decide how that term got invented. So we all know it's a very sort of abstract term, but the way I think about it is commercial bankers deal with loans.
Okay.
They lend you money, you borrow the money, there's an interest rate associated with it and a payback schedule. That's commercial banker. Investment bankers are more dealing with equity, which is abstract, right? It's sort of what's left after you pay off. It's the value of the company after you pay off all the debt. And so we're really focused on equity transactions. So if someone wants to make an acquisition and the acquisition is the valuation of the target company is more than the buyer has, sometimes the buyer has to find a way to issue equity or debt or both to buy that company. And so we're really focused on the equity side of things, which is just a harder thing, more abstract, harder to value, and more precious to the equity holder. So investment bankers raise capital. And then the other thing we do is we do mergers and acquisitions. So you can either represent a seller and negotiate on behalf of the seller and find the buyers, or you can represent a buyer and help the buyer find the right target. And many investment bankers operate on both sides. Because I operate by myself, I like to represent the sellers. That competitiveness, I think, is critical here because I feel like a Marine. I get in the trenches with my client and I'm fighting like a dog to get that client the best, not just the best price, because it's more than price. That's obviously very important, but deal terms. There are all kinds of arcane deal terms that we can go into if you like, but escrows, representations and warranties, indemnification, survival periods. We fight to make sure that those terms are favorable to the seller. So I like to represent sellers because I feel like I'm a good teammate and I'm an aggressive negotiator and a loyal advocate, and I go to the mat for them. But when I represent buyers, I try to do the same thing on the buy side and get them, and try how inexpensively can we buy this company to help you grow your business.
So you do work with buyers as well?
I do work with buyers as well. It's harder because you're sort of knocking on doors, hoping that a seller answers and says, "Sure, that's a great idea." Most of the time, they shut the door and say, "We're not interested." So it's a longer process, and so in our business, time is money. So if you can do something faster and more efficiently, it's better in our business. And buy side is just it's less efficient and harder.
Understand.
Well, we do both.
Running down the list of transactions on your website, and I'll put a link to that page on your site in the show notes for folks to visit. But I see a variety of transactions, including sales and IPO and debt and equity, but also what seems like a trend, assuming they're in there chronologically. There was a lot of financials at first, and now more and more industrials. What's taken you in the direction of more industrials?
Oh, I love industrial companies. This is really interesting question because my very first client at RS Finance after I started my company was a scrap metal recycler in the Midwest. And so that if ever there were an industrial company, that would be it. So big, heavy equipment, a lot of rolling stock, big auto shredders, 10,000 horsepower, $15 million machinery construction that shreds up automobiles in a matter of seconds, and all kinds of industrial suppliers around you, right? So great, like trucks bringing scraps of steel, scraps of aluminum, copper, all kinds of things. So that was great because you get, especially in the Midwest, you get into the middle of the country, and you just see there's highways that run up and down and east and west, and you see the supply chain and the distribution infrastructure and the whole industrial heart that drives GDP in this country, or a major driver. So I just thought it was so cool. I love being figuring out how things work and how things get from origin to the consumer. It was really interesting. And success begets success. So once you distinguish yourself in one industry, people are like, oh, that's the scrap metal lady. And I think, okay, I'll be the scrap metal lady.
When you were working at Goldman, did you envision you'd be the scrap metal lady?
No, I did not. I don't know. I don't think anyone pulling those scrap metal. I'm pretty sure.
How do you decide if a client's a good fit?
I like everybody, right? All clients are a good fit, but really to answer your question, I think I have a pretty strong personality, so they need to be able to deal with that, which most of them can. I think they appreciate the leadership because I know what I do and I can take charge there, and they know what they do. So ability to sort of listen to someone who's going to assert herself, somebody who knows that he or she is ready to sell and has really thought about this. So we could talk about that if you want to dive into that. Like the seller, I need to be convinced that the seller's ready and not just sort of testing the water, because it's a very long, arduous process and very emotional, and you don't want to sort of get halfway and find out that it's not worth it. The company needs to be in the size range that we talked about, 15 to 50 million. That's where I specialize, and that's where I know the buying audience primarily. And so there are ways to figure out what is this company worth. So size, readiness, and ability to sort of take direction when given. And I'm not dictatorial by any means, but I need them to trust that I know what I'm doing, because it's very intense. And if they don't, you're not going to get a good result.
Given that intensity, how many transactions or how many clients do you normally manage at once?
So I try to limit it to one at a time. It doesn't always work that way, but that's the perfect cadence for me, because what I say to the seller is, ideally, you do this once in your life, right? You don't want to make a false start and then have to regroup and try again. So once, and I want them to know that, in my opinion, it's the most important financial transaction they'll ever do. Typically, the majority of the seller's wealth is tied up in this company asset. And so I want them to know, I've got you on this, and my interests are directly aligned with yours. So I'm not going to be distracted by anything else, and you have my full attention. And if we don't succeed in a way that makes you happy, then I don't succeed, because I get paid if the company's sold. I don't get paid if it doesn't. So our interests are aligned, and they know that I'm paying attention. Sometimes another one comes along, or it went on hold and it comes off hold, and I have more than one. But typically, I try to do one at a time.
Obviously, the decision to start your own firm was born of a challenging situation, but it's proven to be a great decision. Have you made a decision anywhere along the way that you worried was a mistake, but has worked out really well?
Oh, it's so hard. Sometimes I think about, what if I had taken on a partner? How would that have gone? Then we could, because you can do more transactions. You have less risk, obviously, right? If a transaction doesn't sell, if a company doesn't sell, I don't get paid. So there's some risk there. So if you're doing lots of them, then you de-risk the business, and you can grow if you have more people. I often think about that. The reality is that doing this on my own has been a great life lesson for me personally. You learn about yourself. It's almost like, I never did Outward Bound, but people who've done it say, when you're out there and it's only you and you got to figure it out. It's a moment. And so this has been the greatest growth vehicle for personal growth of anything that I've ever done. And I wouldn't change it. I do think about what if, but you can't really second guess. But I think it was the right thing, and I'm happy that it worked out.
You're active in ACG, or Association for Corporate Growth, kind of the middle market transaction group. My experience with that group is that it's very open to M&A advisors and professionals. There's a lot of those folks that are part of it, active at events. They say it's open to corporate leaders. I've never found many of those. I haven't really participated since before COVID, but that gets me thinking about the way that companies think about transactions. And we talked about how often there's a catalyst that triggers it. And that's, I guess, as opposed to having it always on the agenda for the board, maybe not every quarterly or monthly meeting, but semi-annual or annual. What should companies be doing as part of their routine planning? How should they be thinking? Maybe what kinds of opportunities should we look for to buy? What initiatives should we look for financing to undertake? At what point should we take some of our chips off the table, or a recap, or completely sell the business? Even kind of backing up from a return on equity perspective, should we even continue to run the business, or should we sell it and put the post-tax proceeds to something else? How, I guess, the long-winded question for the middle market, do you agree? Is my impression correct, based on your experience, that companies don't think as proactively about transactions as maybe they should?
I think your observation is correct. I think, in my experience, again, we're talking about the lower end of the market, not General Electric, where you've got a million guys running in different divisions, and then guys below that, whatever. We're talking about owner operated. Typically, the owner is so engrossed in the day-to-day operations, and you're trying to put more widgets through your manufacturing process. You're trying to make them better, quality control, and ship them more efficiently, whatever you're trying to do. And there's always something that goes wrong. This person's disgruntled because bonus wasn't what the other guys was, or I wanted that promotion I didn't get, or my kid is sick and I can't come, whatever, right? There's a million things. And owners are always, even without these exogenous events that come up, there's internal stuff that distract them. There's day-to-day operations, and then there's the random exogenous, like, our competitor just took our best customer, our machine broke, or whatever it is. So they don't really have time. It's so interesting when I talk to business owners, they say, yeah, probably in 5 years, I'll think about it, because it's far enough away. They're sort of like, it's on the radar, but it's not something I have to think about today. And if you talk to them in 18 months, they're like, man, probably in 5 years, right? So it's always... And to a person, it really. So I don't think that it's front and center for an owner. And I like the idea of having either a board of directors or an advisory board, because they can hold you to task. They can sort of ask the hard questions. They can help you think about it. I don't know if I'm answering your question, but that's sort of my observation about how business owners think about selling. And then one day, and this is happening a lot now, I have a lot of clients who aren't ready to sell, but they'll send me emails that they receive from a buyer that says, hey, I noticed your company. I really want to buy it. Have you ever thought about selling it? And these emails are getting more and more clever as the years go by. And some people, it's the same guy saying, I always wanted to buy a scrap metal company. And then the same guy says, I always wanted to buy a cosmetics company. You think, it's the same guy, but the owners don't know that. Anyway, that's a catalyst that can often prompt this thought process, like, hey, this guy wants to buy my company. Maybe I should figure out what to do, whether to sell it, how to sell it.
But thinking about potential opportunities if the economy slows down, and there'll be more boomers that suddenly say this isn't fun anymore. I want to sell. If you're a $50 million company that doesn't have a dedicated corporate development function, has a board that tends to be maybe more friends than M&A experience, independent directors, people with that perspective, who owns that work? Who should be thinking of building whatever the process is, building a matrix for the kinds of companies to think about buying, and who investigates investment bankers, and at what point do you create that relationship? Someone's got to do these functions so that you're prepared, right?
Yeah. Most of the time, it ends up falling on the owner, unless he or she has an advisory board. And I can give you a great example. In a couple of transactions ago, the company actually did have an advisory board, which I thought was really smart. They had a lot of foresight. I don't know how it evolved, but they had 3 people who were, one was from private equity, one was from wealth management, and one was a technology executive who had sold his company. So, and none of them knew each other, but they were all just intelligent business people who were probably late 50s, early 60s. So they had wisdom and experience. And those people, when the seller got, the CEO got an unsolicited offer from a buyer, and this was a woman in this case. She didn't know what to do, and she showed it to her advisory board, and they started to think about, okay, who would other buyers be? Maybe we should be a buyer, and they did that matrix on behalf of the seller. But sometimes sellers don't have those people as resources, and then they've got to find someone. They typically will go to their lawyer and say, hey, have you ever seen this? What should I do? And that gets the process started.
Is that where a lot of your referrals come from, lawyers?
Lawyers, yes, absolutely. Lawyers and accountants, because business owners also think, well, what's my company worth? I don't know if I want to sell it. If it's worth $1 billion, maybe. But if it's worth $1 million, maybe not. And so they'll think, well, it's numbers. So I'll ask my accountant if they know what it's worth. And accountants can do valuations. They're not practicing mergers and acquisitions necessarily. Yeah, some do, and some try to do it. But they're not solely dedicated like someone like I am. So they will typically know people like me. They'll know investment bankers and business brokers, and often recommend us or ask us to help with the valuation. But yeah, lawyers and accountants are key referral sources.
And so if the owner or the CEO is typically the person that owns this, unless they have the foresight to put together a board of advisors or some independent directors, that brings me to the question, what about the CFO? I mean, in my experience, often in that lower middle market, the CFOs tend to really be more like controllers with fancy titles as opposed to strategic finance thinkers. Is that fair, unfair? What's the role of a CFO in helping to drive this process?
That is a great question. I think you're absolutely right. In the sub $50 million market, you usually have a controller or a director of finance. And you've nailed it. People have said to me, what's the difference between that person and the CFO? And it's the strategic thinking. It's sort of, the CFO is like the CEO, which is in wearing a finance hat. So what could this company be? And if you say it could be twice as big, the CFO said, well, how do we get there? What kind of capital do we need? What kind of company should we buy? And the CFO can figure out the financial aspects, whereas the CEO is doing the same thing, but more from a strategy, operational standpoint. So when companies don't, they typically, my clients typically don't have CFOs. They have controllers and directors of finance. And those guys, they're not trained to think strategically. Right. And so they don't necessarily know how to do this. I mean, they're smart, so they could figure it out, but they usually look for help. And that's when they'll go to their CPA, the independent accounting firm, and be like, can you help me? What should I do? And ultimately, someone like me gets introduced.
The interesting question that raises is none of us know what we don't know. And so thinking about industrials being pretty conservative, they typically don't have a ton of debt, maybe a standard commercial banking relationship with a revolving line of credit or something. But often I think they have hesitation to even consider transactions or strategic initiatives because they don't want to spend the cash. They want to keep the powder dry. There's a lot of alternative financing options that are available, whether it's through debt or equity. And you obviously have a lot of expertise in that. How should take the M&A out of it for a company that's, say, a $50 million company that thinks there's a huge opportunity for them? They could double in 5 years. How should they think about access to capital, and who should they talk to, and what kind of questions should they ask?
They should talk to an investment banker, and they might meet the investment banker. Again, we just talked about this through a lawyer or an accounting firm, an accountant. But an investment banker will know where to find the capital. So typically, if you want to double, you might need equity. Maybe you could fund it with debt. It depends on the underlying financial profile of the buyer and the seller. And so the investment banker, we're trained to do this. This is what we know. This is what we study and what we learn. The projects we work on teach us this. But we will look at the company on a standalone basis and the target or various targets and figure out, okay, if it's this one, we could finance it this way. And if it's that one, then we will need to finance it this other way. We know where to find the capital. So in my contact management system or whatever it's called, CRM, I have 7,200 names. Now, a lot of those people are probably retired or gone somewhere else. But suffice it to say that I had thousands when I was just raising capital, and now thousands more on the M&A side. And capital comes in different forms. It's not all debt is the same. So we used to do structured debt. So maybe you don't pay any principal for 1 year, 5 years. Maybe you don't pay any of it, but you're paying interest. Or maybe you're paying interest. Crystalling, like you're paying off 10% this year, then 15% in the 20. I mean, we do a lot of structuring. We say the cash flow characteristics of the buyer, of the underlying company target, both have to be sufficient to manage this capital load that we're putting on it. And so all of that is technical stuff that we learn to do and we can help with. But it's fraught with peril. I would say it's pretty, unless it's a very simple deal, most business owners should seek the assistance of a professional who focuses and specializes in this.
So an accountant or an attorney will often say, you ought to talk to an investment banker. Here's one I know, good person. How does a company go about vetting various investment bankers and selecting one that's a good fit for them?
Yeah, that's a really good question. It's hard to do, and I see some people make mistakes. The business owner has to ask a lot of questions, and lawyers can help. Lawyers have seen good investment bankers and good brokers, and also have seen weak ones. So lawyers are really smart, and they do a lot of transactions. Accountants, same thing. Sometimes it seems to me that most business owners have friends who are other business owners, and they may say, have you ever had an experience with something like this? And everyone's got stories. So typically, if you access your network from various perspectives, you can vet people. But it's so important because in the old days, there were 6 firms that did this. Goldman Sachs, Morgan Stanley, Lehman Brothers, First Boston, Payne Weber, I don't know, whatever. There's a small number. And now anyone in the world says, I'm an investment banker. And maybe not. It's hard to know. And you're talking about an asset, your company, that represents substantially all of your net worth. You don't want to make a mistake there.
And a lot of ego. And a lot of who you are as a person, too. And that could be even trickier than the financial part. That's a great
point. You're absolutely right. That sort of the people defines the business owner to a large extent.
So we're talking a lot about kind of what I would equate to maybe kinetic energy, the actual transaction, the process of the transaction. We've touched on maybe the analog to potential energy, how you prepare before you intend to do a transaction. How do you prepare? And so there's some stuff to do as a seller. There's some stuff to do as a buyer to just say, we want our radar up. So when this constellation of circumstances happens to align, we know it's time to pull the trigger. We've done the thinking, we've done the modeling, we generally know what we want to do. How do you advise companies, if you really just focus on the transaction piece, how do you advise companies that don't have that internal corporate development, that don't have people on staff that have done this, and the owner is overwhelmed? Where do they turn to build that kind of that background plan that sits there passively in the background so that they're ready when they have to do something?
So the advice I give to owners who are thinking about selling, like if I meet them before they want to sell, which is actually rare, but sometimes I do, I say, things to keep in mind. You want to sell when your revenue is, your sales are trending up. Mm-hmm. Right? Because a buyer typically will extrapolate whatever trend it sees. So if sales are going, even if they went up for a while and then down 1 year, buyers are like, oh, the end is coming. It's only going to go down. That's sort of the mindset. So you have to know how those guys think. So sales are trending up, profits trending up. I tell the sellers, you need to know that you're ready to sell. You just made a very important point, which is it's their identity. So sometimes they're not ready to separate from being the person at the company who everyone says hello to in the morning and is eager to please, and or like the guy at the country club who everyone knows because he runs this company in town or whatever. Right. So the seller emotionally needs to be ready. The financial profile needs to be trending positively. Operationally, the company should be kind of fit, if you will. So you don't want to have equipment that's really run down. You don't want to have lost a major customer. Right. You want your property, plant, and equipment, your operating facility, your operations themselves to be pretty finely tuned. They don't have to be perfect, but they need to be in good shape. And then so we talked about emotional, financial, operational. Those are the sort of the categories. I think you just sort of need to be ready. And it's also important, I guess I would say, administratively, entirely. Like I've sold companies where the buyer says, we need to see the actual contracts that you have with this supplier or this customer. Right. And the seller says, I don't have it. I lost it, or we haven't had it for a decade. But the customer is still buying from us, or the supplier still. So having your sort of documents in shape is also useful. Lawyers have figured out ways to get around it if you don't have them, but you should try to get your paperwork in order, leases, contracts, things like that, employment agreements, stuff like that. But so that's how sellers should think about it. There's nobody internally who's going to give them that discipline, but like listening to podcasts like this or talking to people like me, lawyers would know this type of thing. So, how do we, and it just makes sense. If you're a business owner, it just makes sense to sort of say, okay, we want to sell when things are looking good.
And based on your experience, how far ahead, they all say, okay, I'm going to sell in 5 years, but how far ahead do they need to begin? If they're typical, reasonably well run, but not quite as disciplined as they should be, is it a 2-year cycle? Is it a 3-year cycle? How long do they need to really get the revenue predictively trending and get everything buttoned up?
The thing about running a business is you just can't know what's going to happen tomorrow. So right. You should always, as a business owner, you're always thinking about these things. I'm sure they're coming to work every day saying, today's going to be a good day. I'm going to make it happen today. You have to be in that mindset. I would say a lot of business owners respond when they get that inquiry from a would-be buyer, and they're ready because they're close enough, right? But really, when we're talking and like I go to a lot of these meetings and we give presentations on how to think about it. We say if maybe 1 year in advance is a good way to do it. And the reason for that is a business owner typically has a wealth advisor, somebody who's managing the excess cash that the business is generating and that the owner's collecting. That wealth manager can put in place, if the wealth manager has a full year, the wealth manager can put in place tax strategies that can beneficially impact the seller when the sale happens and also after the sale. So talking to a wealth advisor a year in advance, really good idea. And that person also can typically say, what life do you want to live after you sell?
Sure.
Do you want to travel? Do you want to do whatever, kids getting married, whatever ambitions you might have, like go skiing, buy a house in Vail, whatever it is. And the wealth manager can say, your company's not worth enough yet to be able to do that. So your company needs to be worth this much for you to be able to enjoy that kind of lifestyle. So, or if the wealth manager doesn't know, they can find someone like me to value it and say, here's a value. But a year is probably a good way to think about it. That gives you enough time to prepare.
Okay. We spoke earlier about the role of boards, and I know you've sat on a number of boards, public and private. You told me a story during one of our conversations about an experience you had a few years ago with, I think, a leader or some sort of a senior person in a large director-related association who indicated, or maybe alluded to the fact that women weren't the best board candidates. My sense is that's changed, but you would know better than I. Has it, or do we still need further to go?
I remember in 2011 hearing about this initiative called 20 by 20. And what that meant was public companies wanted to have 20% of their directors women. So if you had 5 directors, at least 1 would be female by the year 2020. And in 2011, there were like very few female directors. But that was the first year that I became a director, a board member of a public company. And to be honest, I don't know if I am different from a male board member. I have no idea. I was put on boards because I had exceptional capital markets experience. These are public companies. They needed to access the equity market. They wanted to move from OTC to NASDAQ or whatever they wanted to do. And this was my training at Lehman Brothers for many years. So I understood, all the things around being a public company from a reporting side and investor relations side, capital raising side. And my male counterparts didn't. They were better at other things. They were doing operations or they led other companies. So I can't tell if females are different from males in that regard, but there is research that suggests that the experiences we have as women are different from experiences that men have, and it's the difference in experience that enriches the dialogue at the board level. And so I would have to say it makes sense just intellectually. If you think about it, half the population of the 7 billion people on the planet are female.
I think actually a little bit over half.
I mean, maybe we've got the upper hand there or whatever. But the point is, like, why would you not access half of, there might be some talent there that could be helpful. And so I think it's good to just keep an open mind. You're picking the best athlete. You're not picking male, female. You're picking the best athlete in that role. Right.
Yeah, I think that's such an important point, that you look for the skills and then look at the variety of people that may bring those, and what other aspects, what other perspectives on your skills board matrix will some of the candidates help you satisfy?
Exactly right. That's exactly right.
When you think about great governance versus what may be kind of the norm among most middle market companies, what do you think is the biggest opportunity for performance improvement if the board were to be a little bit more active in their oversight role?
Uh, the boards, I've seen boards that get complacent. They're meeting infrequently. Maybe it's quarterly, maybe it's even less. It's usually quarterly, especially on public companies. And they're not really up to speed on what's going on. So they get a board package. They typically get it the day before or the day of. And so they haven't really studied it.
Right.
And it's human nature to kind of play nicely. You try to get along and find ways to be agreeable. But my observation and my belief is that you need tough love on your board. Right. The best boards, I think, will have somebody. You're not trying to be intentionally difficult, but you need to ask very hard questions like, why aren't you thinking about making an acquisition? Or why haven't you invested the capital to expand your operation this way? Or whatever those questions might be. It's obviously very circumstantial depending on the company that you're on the board of. But hard questions, tough love. Some board members they want to ask hard questions like, how come we don't have sales? We need to have sales. You're going to grow this. Like, what's going on? Right? So you really have to challenge. That's the only way to. If you want to be a world-class athlete, but you never go to the gym, chances are you're not going to have that fitness level. So you got to do things that are hard to be great. And the board needs to discipline and push the management to do that, in my opinion.
Based on your experience, what do you think is the right size for a middle market privately held company? How large should the board be?
Oh, I think 2 to 5, but I would say 3, maybe 4, something like that. Really, it's more important to populate your board with the right people. So it could be 1, if that's all you can manage or afford or whatever. But you want a tough love person. You want skills that complement what the CEO doesn't have, right? Mm-hmm. So the CEO is very tactical. You want someone with strategic insight, or vice versa, right? If you're having a hard time finding talent, maybe you want somebody who has a little bit of who's attuned more to the human capital part of the process, right? If you don't have a good finance capability, maybe you want somebody with capital raising experience or M&A experience. You need to look at where your weaknesses are and populate accordingly. And that's probably 3 people. It depends. If the company's bigger, maybe it's 4. But,
and what percentage independent?
Oh, gosh. All but the CEO, typically. Okay. And for the companies I deal with, really, the CEO is the only one who's from the company. Everyone else should be independent. That's where the tough love comes, right? The independence allows you to do that.
So speaking of how maybe a company would need somebody with capital experience on the board, are you available for additional board roles currently, or are you completely full?
Oh, I could always do a board role. Because the meetings are sufficiently infrequent, right? And
as long as you get the prep book, a week ahead of time.
Exactly. I'm a good studier, so I don't typically cram for exams, but I can if the work package comes late. No, I'm always available to do that. I like doing it anyway. I think a lot of people that I'm not working for in an engaged, formal engagement will call and be like, hey, this happened. What do you think about that? So it's very stimulating to be put in those work positions. I love it.
Got it.
Yeah.
At the recent Private Company Governance Summit in Washington, D.C., I saw some really interesting data from a group called Compensation Governance Partners. And they look at director compensation, the cost of running boards, and that kind of stuff. And they reported that for companies in the $25 to $50 million revenue range, the cost of governance was about 0.3%. And for $50 to $250 million, it was about 0.1%. Yet, my sense is that often privately held business owners recoil at the idea of paying independent directors. Of course, much less the whole conversation about losing control. Do you have any way that you can quantify for companies the benefits of why it's worth them investing in that improved governance and making that relatively small investment?
You get one good idea that moves your revenue forward, moves your costs lower, makes your operations modestly more efficient, helps you hire one excellent employee, gives you access to one lender that you didn't know. I mean, that makes and board members don't get paid all that much.
Right.
I mean, even on public boards, we weren't doing it to get rich. We were being paid basically for the inconvenience of having to travel wherever in our time. But I'm not surprised to hear those statistics that you just cited, because the cost is so little relative to you're hiring people who are experienced, intelligent, have insight because of their experience and their intelligence. You should always be getting more for your money than it's costing you. And it's hard to quantify those things, but you see them in the business.
But I love the way you drill down, because intellectually we can kind of understand, yes, it's worth it. If you're a $50 million company and you're spending $300,000 a year on meetings and travel and director pay and that kind of stuff, you're likely going to realize benefit from it. But your point about, I mean, to have somebody bring in insight that helps you generate an additional $300,000 or $1.5 million, 5x of additional profit from a $50 million company, is very reasonable. And so to make it granular like that suddenly makes it seem much easier, I think.
Oh, my God. Yeah. I'll give you one more example. I went to a facility and I watched an hourly guy carrying something from here way over there. It's like a 35,000 square foot. And then he carried it way over there. And then he carried it way. And I thought that every step that guy takes is costing you money. Like, what if you just had this is very obvious, but not to that owner. It wasn't obvious that you would have your plant laid out in a very logical way. So that guy doesn't have to move. He just puts the box on it. Things like that. I mean, that's a very extreme case, but, owners aren't always thinking that way. They got a million things in their head, and they're not always focused on something that another person sees right away.
But then there's this challenge of nose in, fingers out. And so you want to provide oversight without getting too operationally involved. How do you recommend directors or owners of businesses kind of build that firewall and directors observe it?
Yeah. The boards I've been on, the directors have been really good. They're experienced, and I won't say that they're lazy, but they have their own million things going on. So they often don't read the board packages for the reasons I said earlier. They listen, and because of their experience, they can just respond to what's going on and with insight. And that's nose in, fingers out. And sort of like, well, we saw that. And what we did was we just laid our plan out in a very efficient way, and it worked better. We saved this many hours. And, they'll have quantitative data to back it up, right? It equated to this much dollars. So boards, by the time people get to the level in their career where they become board members, they're not like inclined to get into the weeds, in my experience. And if they are, the CEO should tell them, like, I got the operations. I just want your perspectives. Thanks for the, right? You can push back. Board members don't take it personally. Right.
When you're spending 16 hours a day with an owner in the throes of a transaction, it's got to be tough. I mean, how do you recharge? How do you burn off stress with the kind of workload and intensity that you have?
I thrive on the stress. I probably create it for myself just as a driver. But I get on my bike. I have a bike in my kitchen because I'm not using the kitchen for kitchen things. And so so the bike is a good way to kind of decompress. But yeah, it's intense. I think thinking back to the early part of this discussion, I think the person at Lehman Brothers who chose competitive athletes to be on the team an insight. Like, these are the people who are going to get it done. And by the way, this woman was from a military family. These two brothers were both Marines. So, and they were older than she. So she saw that too. It was sort of the same skill set, right? Like, everyone decompresses differently, but we figure it out. Or we don't, right? We just keep going because that's how we are, right? We're wired that way.
It's like a lot of those CEOs who never have time to think about tomorrow.
Yes, correct.
No pickup soccer league? You never had an urge to coach or anything like that?
I used to play pickup soccer years ago. Once I started my own company, all that stuff ended. But every city that I worked in, they had a league. It was really good. It was so fun. Plus, you meet a lot of people. You get totally lost in that way.
Right. And how about managing days and weeks? I'm always fascinated by what people do. Do you time block? Are you more effective early or late? What have you settled into as a routine that makes you most productive?
So my circadian clock is a late night clock. I do my best work after 6 p.m. So 6 to 2, I would say. And wow. The phone doesn't ring, emails stop coming. It's like really good time of quiet and solitude where I can think and process and look at things critically and, make them right, make sure they're right. Everyone said that as I age, my clock would change to a morning clock, and hasn't yet. I'm waiting. But no, everyone's different. You just have to figure out, and it's not, you don't know it right away, but you figure out, okay, like, when does stuff happen? Virtually all my clients would call with warning. They starting around 7:30, you start to get, and then by 10:30 that they're done. And then you can, right? So you just manage around it. I'm the service provider, so I sort of respond to what others want. I don't dictate that.
You're talking about working till 2 a.m. and I'm thinking, geez, that's when I'm starting to think about getting up. I'm definitely on the other end of it. Kind of 4 to 7 is my time to write and to think and to work unmolested.
That's awesome. Yeah, it's each his own, right? As long as it works for you, that's all that matters.
So owners of middle market industrial manufacturers intrigued by this conversation, wondering, maybe I need to be more proactive in thinking about either making an acquisition or being ready to sell my business. What books or podcasts or YouTube channels or associations like ACG, what do you recommend they follow or read or join?
That's a great question. I'm not sure I'm going to have any real response for that. There are probably... I do know that anything you Google, like sell my business or anything with those combination of words, you'll find a lot of different things. And it's probably good to listen to multiple things or read multiple things because, as I was saying before, some people are more credible than others. Some people are more experienced than others. Some people, and the melting pot of different ideas can be very, you can sort of get to the truth if you boil all the ideas into a big cauldron and extract the best ones. So there's information out there. A lot of people like me will talk, I usually meet a business owner right when they want to sell. And I think, I wish I'd met this person 6 months ago, right? Because not everyone's willing to have a conversation, but many of us are. We'd rather just have it, the seller be ready and get ready so that by the time we start working together, it's very smooth. And so lawyers will have that conversation, accountants, your advisory team, or external advisors will help you.
So for people that are interested in having that preliminary conversation with you, what's the best way? How do they reach you? Go to your website, look up the phone number, shoot you an email, call you? Do they connect on LinkedIn? What do you recommend?
All of the above. So my phone number and my email address are on the site. It's actually a general email address, but people can reach me from my website, rsfinco.com. My LinkedIn, I have a very unique name, so it's easy to find me. I try to respond to everything that comes in. Sometimes I don't, but when people ping me again, but I do.
Okay.
It's a great way to, I'm open to all that. I love it.
Wonderful. There's my sense, you would know better than I, but I think there's a frenzy, and we might call it a frenzy of private equity right now. how much longer do you think private equity will remain a viable buyer for a lot of middle market industrials?
Oh my gosh, there are so many firms now, more than ever, as you observed. Very few barriers to entry because now people can say that they run an investment firm and what they are is a deal finder, and then they go and find the money because there's so much of it out there. I think we're going to have this for years to come.
Really?
It's my sellers will often say, I don't want any private equity. I just want strategic buyers. And when you look for the list of strategic buyers, you find that more than half of them are owned by private equity. And so, you might make a call to that strategic buyer, but he's getting or she's getting the money from the PE that's backing them or something like that. But it's become a legitimate and permanent asset class. It's getting the pricing, the cost of private equity is going down, which is good. But I think it's here to stay for the foreseeable future, as far as I can tell. It's probably going to keep growing for a while.
So I thought I might hear you nervous about that. Obviously, you're not. So then I guess what is making you nervous right now? If you're thinking about a seller who's happy but going to want a transaction in a couple of years, what do you see on the horizon that makes you pause?
The state of the U.S. economy is concerning. I mean, we're a very strong country, obviously, and probably one of the strongest in the world, if not the strongest. But fiscal policy and monetary policy are tricky things. And I think we've had some situations that have caused us to inflate the economy or infuse capital into the economy, which causes inflation. It's very hard to manage in a business when your costs are getting ahead of you. And it's just, again, we're probably the best of all the countries, but that makes me very nervous and can lead to a lot of disruption in the economy. If the economy's not good, businesses aren't going to perform well, and that's going to be a problem.
How about political and domestic and international political instability? Does that inhibit transactions?
It can. Sometimes we have sellers who say, I don't want to sell this year. It's an election year. And, if this outcome happens, that's bad for me. And if this one happens, it's good, but I don't know. And that was true, I think, 1 and 2 elections ago. But this year, what I'm hearing is, I'm still hearing that a little bit. Some consternation about the outcome, but a lot of people are saying it doesn't really matter. Like, all I can do is what I can do. And so we've got these things moving around. They're unknown. They're going to be what they're going to be. I think people are less concerned this time than in the past. There's still a lot of, there's just still a lot of worry, but what can you do about it, right? There's a war in the Middle East, and there's a war in the Ukraine, and there's issues at our border, and there's issues all over the place. But all a business owner can do is what he or she can do. So
it's almost like all that talk over the last couple of years, people increasingly referring to the Stoics and adopting Stoic philosophy. Maybe it's kind of pervading the way business people think about their opportunities.
I hope so, right? All you can do is what you can do. You can't control that noise, so you got to just hunker down and focus on what you can control.
Experience tells me that really accomplished people like yourself often have things that they enjoy, that they put time into, but never achieve the same degree of proficiency that they're accustomed to, that you had with sports, you've had with investment banking. What's something that you love that you've really tried to get good at, but you're not as good at as you are accustomed to being?
I think I eliminated all those things from my life, so I wouldn't have to answer it with that. No, I'm kidding.
All right, fair enough.
I always want to be like a better athlete. I always want to be fitter. So I talked about my bike earlier, and I was trying to figure out, like, how can I make my resting heart rate below 50? And so I was inching in that direction, and then I broke my wrist, so I couldn't ride my bike for a while. Ooh. So now so it's sort of like a myth of Sisyphus. You're pushing that boulder up the hill, And the boulder
Right.
rolled back on me, so I got to start over. But I would say I like things that where you can never get there. So asymptotically, you can approach your goal, but you can't. But the goal is so elusive that you can never quite get there. And so
how do you avoid getting discouraged?
well, it's the hope, right? It's sort of like maybe I'll get there. I'm going to keep trying. Maybe I'll do this differently, and maybe I can do it that way. And so the goals I set are ones that can't be achieved, and just because that's what drives me, right? I set unreachable goals, and I can get close, but I can't get there, and that just makes me keep going.
Wow, that's powerful. All right, we're coming to the end. Wrap all of this conversation up. Here's an easy question for you. 3 minutes, kind of what should middle market industrial manufacturers really know about investment banking and transactions, and how should they be thinking about opportunities right now?
And owners should be thinking about, should I grow or am I ready to sell? So that makes the buy or sell decision. And depending on that, what are the characteristics? Let's just take growth for a second. What are the characteristics in a company that I seek that would make my company better? So that's a thought process in and of itself. And then who are the advisors who can help me implement this plan? And the same thing on the sell side. That's the side I know better, so I'll spend more time on that. Like, am I ready to sell? Why do I want to sell? Do I really want to sell? What will I do after I sell? And how do I make sure my company is as fit, physically fit, operationally fit, financially fit as it can be? Because that's when I'm going to get the most value. I don't want to sell on a downturn. I want to sell when things are going well. So what can I do to get this business ready? And again, it comes down to getting trusted advisors who can help guide you.
So on that note, I'm going to put the website address in the show notes. People have to look it up. They have to get in touch with you. They have to have those conversations early. This has been fabulous, Rudy. What a gift you've given people of your years of experience and wisdom. So thank you. All I can say is thank you very much.
Thank you very much. This was great. Thank you.
Good. All right, everyone listening, please don't forget to like, share, comment, subscribe. You know the drill. Hit the bell. Make sure that others get the benefit of Rudy's insights. And thanks very much for listening.